Howdy there, folks. Welcome into tonight's video. We've got a couple things to get into. First thing is here, this video, Danny Moses from The Big Short talking about the Fed and what they're doing to the market, what they're up to, where the market's going now, and his perspectives on all that in this video. So we'll get into that one. I'll react to that one and give my opinion, okay? First thing I actually want to react to here is Lennar numbers that just came out here a couple hours ago, okay? I want to take you through a few very important numbers so you can kind of understand what's actually going on in the real estate market based upon a company that's one of the biggest home builders, if not the biggest home builder in the United States of America, right? And I'll take you into these numbers real quick here, and we'll kind of take a peek around so you can actually know what's going on in real estate, because if you really want to know the reality of what's going on in the real estate market, don't talk to realtors, don't talk to a lot of folks, okay? Because a lot of folks are just, let's say you speak to a realtor. Their realtor knows, first off, like, they might not be doing well themselves, right? So it might be just they're having a problem in real estate. Secondly, like, they're only going to know really their area and what's going on with their area. A company like a Lennar, big home builders, right? If you look at their past numbers and also their backlogs, numbers like that, you're going to get a good context of what's going on in the entire United States, because many of these big home builders participate in 20, 30, 40 different states. And so they're wide ranging across the United States of America. And when you see their home orders are very weak coming in, you know the real estate market's bad, right? And when their home orders are obviously coming in very strong, that's when you know that the housing market's in a very strong place. And so we'll dive in there real quick and I'll take you a little look around. By the way, if you're wondering why I'm like sitting in this position, it's because I told everybody this on the main channel. I don't know what happened. My heel is messed up bad. I thought my wife was going to have to go get me crutches. Like, I got out of bed. Oh my gosh, it was like excruciating pain in my heel. I think I messed my heel up running yesterday or something. So nonetheless, folks, yeah, it's going to be sitting down videos for me for the next few days here, because it's not the best, okay? And by the way, 24,500 plus subscribers. I mean, a new record after new record after new record. Thank you, every single person that enjoys the channel and subscribe to the channel. I appreciate y'all, okay? So when it comes to Lennar, right, net earnings per diluted share increased 22%. I mean, dude, that's incredible. That's super strong. Like, what am I going to say about that? That's amazing, right? Decreased 21% to 212, excluding mark-to-market losses on technology investments in both years, right? Net earnings increased 18% to $597 million. Deliveries increased 9%, okay? So right off the bat, good. But this is where things go wrong, and they're going really wrong, okay? New orders decreased 10%. New order dollar value decreased 18%. So the dollar value is going down even faster than actually new orders coming in, right? Which means that the people that are buying homes are buying cheaper homes from Lennar. Backlog decreased 29%. Backlog dollar value decreased 33%. Now, I will say, compared to Toll Brothers, those numbers are actually impressive, because Toll Brothers numbers were down like 50, 60% type numbers. But those are also in terms of orders for Toll, right? But this backlog is extremely worrying, okay? And the reason being is basically what this tells you is Lennar's got this year still on lock as far as like putting up great numbers, revenue numbers, and obviously earnings per share numbers this year. But the issue is, and this is an issue for all the home builders, right, is they really need, over this next 6 months, like, there to be a demand come in for housing. And they really need people going out there and putting their contracts down and their names down for new homes to be built. If that doesn't happen, what's going to happen is all these big home builders, Lennar, Toll, all of them, KB Homes, all of them, their backlogs are going to dry up, and their numbers are going to be really, really weak for 2024. And I mean really weak. Like, you'll see, EPSs and revenues down, 50, 60, 70%. It'll be ugly unless orders start coming in. And this is another huge reason why mortgage rates have to fall over this next 6 to 9 months in a substantial way. And if they don't, I'm telling you, it's going to be a bad situation, okay? Now, also, because a lot of people have thought about the home builders as like a short opportunity, right? And I haven't looked at them as a short opportunity. That's why I didn't buy put options on any of these stocks going in this year or in the past, because at the end of the day, a lot of these home builders, one, they got money pouring in. Two, if mortgage rates were to drop substantially, maybe their orders start going up again. So that your short position's screwed right there, right? But not only that, their balance sheet's actually in a really, really strong position. I mean, an incredibly strong position. I was looking over things here, right? They're talking about we remain focused on balance sheet and liquidity. According at the quarter end, right? We had home building debt to capital of 14.2%, the lowest in our history. No borrowings on our $2.6 billion revolver, and cash of $4.1 billion, with liquidity of approximately $6.7 billion and no debt maturing until next fiscal year. Our balance sheet has never been in a stronger position. So, if you're trying to buy puts and short these stocks, it's a losing trade. I mean, there's other opportunities that are give you a much better, let's call it bang for your buck, a potential risk reward than the home builders. Those companies are all going to report great years this year. And if mortgage rates were to drop substantially, they could likely start having some demand come in, so their 2024 numbers aren't a disaster. Meanwhile, their balance sheets are pretty much all across the board, and almost all the home builders are the strongest they've ever been. That makes it not a very attractive short candidate in regards to that. Okay, like I said, I think if you're looking for opportunities like that. First off, look for long positions, because there's a lot of stocks that are long, that are very discounted long. But if you're looking for a hedge, I think there's a lot better hedge opportunities out there that obviously I've taken advantage of this year. Okay, next video, or the only video to get into, this Danny Moses one, and what does he have to say? Let's hear what he has to say.
Danny, there's so much to unpack here with you that I want to get to. But first, I'm just curious what you think of this bank bounce, and are you finding any shorts or longs in this sector at this point?
when you come from the movie The Big Short, right, it's always going to start out, do you find any shorts in the market right now? This is interesting. What does he have to say in regards to this? Okay.
I'm kind of taking it all in here. A lot has gone on, obviously, in the last week. A week ago, no one even knew, or some people knew this might happen, but this kind of new. So it's hard to really buy or sell securities, stocks that is, not knowing how the plan's going to be unveiled. And we're getting a little bit more clarity on that in terms of this BTFP, which they could have called BTFD, obviously, if you know what I mean, in terms of what they're going to be providing. And so the problem here, though, is really sifting through. It's not just about agency securities and treasuries.
Anybody that didn't get that, buy the effing dip, okay?
Commercial loans that are on banks' balance sheets, commercial real estate, right, C&I loans, et cetera, that are still going to be a problem. And I think now's the time to really dig in to these banks. So.
Yeah, there's a lot of work to be done. To think that people whose sole living is to analyze these banks, whether it be Wall Street.
So right off the bat there, she asked him, you got any shorts or longs off this? He's like, I'm kind of taking all in, which basically means he doesn't really know what to do. I'll just be honest. When you're a trader and you're kind of like, I'm just taking it all in right now, that basically means you don't know what to do right now. You don't know what the next move is, right? And that should be scary to anybody that's short this market, especially very heavily right now. Because you got a gentleman there from the movie The Big Short, right? A trader that's kind of like, I don't freaking know what to do right now, to be quite frank. I'm just taking it all in. That's exactly what that means. I'm taking it all in. That means I don't know what to do right now, right? And he basically is just kind of like in that position of like, I don't really know where this market's going.
Analysts, ratings agencies, San Francisco Fed, regulate, you name it, they all missed the boat on this. So for all of us out here, there is a lot of work to be done. In terms of, though, guaranteeing all deposits, does that make anything safer in your view? If this became the norm, if this became the rule, that there is a backstop for everything, does that make the sector any more attractive in your view? Stabilize things?
No, I think that should scare people, the fact that the regulators think that they need to go out and actually do that. And so now I think what we're going to see is the banks that maybe come to this window and use this program is going to raise a lot of questions. And you can't assume that the regulators have any idea what they're actually dealing with now, considering that they were completely caught off guard, it appears, by what just happened at Silicon Valley Bank. So that should make people nervous. But again, the first earnings out of the gate that we get for Q1 are the banks. So we're going to see a lot of interesting information come out. So we're definitely not out of the woods. And I think the Fed is kidding themselves if they think that this situation is just going to go away. I think a lot more people will come to this new window, so to speak, to deliver some of these assets.
Hey, Danny, it's Tim. So let's get to, I feel like the Fed and the dollar and even rates were kind of the previews, and we're now at the matinee. It's credit time. And to me, we may have peaked on Fed. We may have peaked on dollar. We may have peaked on rates. This is generally a great time for owning equities, but we've just gotten a glimpse of what goes on in credit.
Wow. Generally a great time for owning equities. Interesting. And what he just said there, listen to this again. This is extremely important. Listen to this, okay? Extremely important.
Dollar and even rates were kind of the previews, and we're now at the matinee. It's credit time.
Peak dollar, peak rates, peak Fed, peak inflation. We've already peaked in regards to all of that stuff likely over this last number of months, right? And different things peaked at different times. And those are all obviously all things that were working against the market, all things that were working dramatically against the market.
And to me, we may have peaked on Fed, we may have peaked on dollar, we may have peaked on rates. This is generally a great time for owning equities, but we've just gotten a glimpse of what goes on in credit. How are you playing that? How do you view credit spreads here? We went up a full 1% in about a week on high yield OAS. I realize it's not, at extreme levels, but everybody says there's no credit dynamic working right now. I'm not sure I agree.
There's been a credit dynamic in place since the Fed started raising rates. We're just now getting the lag impact of that. Look back in the last fall when Blackstone had to gate their funds, when Starwood had to gate their funds. That's really on the commercial real estate side of thing that's been occurring. You had 2 defaults already, right? PIMCO, Brookfield, already, defaulting on office buildings. These things have already been in motion. And this is what I mean about, okay, we didn't see this coming a week ago, or 99% of people did not see this coming. So now it's the all clear. I don't think so. To your point, Tim, you made earlier on the show about cost of capital moving higher. Rest assured that banks now will be forced to have more capital. And like it or not, the big banks are about to get bigger. And it's been happening in real time as we're sitting here. It's probably happening right now. And so that is not what the regulators wanted to see. But to your point, it doesn't change anything. What it did was it basically moved the Fed from a terminal rate or market expectations from almost had gotten high.
Is it really not what they wanted to see? Who's to say that's not what they wanted to see deep down, right? They might say something, but it's like, what does somebody feel deep down, right? Did they really want that? Maybe they want the bigs to get bigger. Did we ever consider that possibility, right? If you have, let's just say you only have, in the entire United States of America, right? Let's say you got 5 banks, okay? 5 banks, that's it. You have those 5 options and that's it. There's no such thing as regional banks, none of that, right? If there's only those 5 banks, right? It's very easy to keep tabs on those 5 banks, right? Because that's all you have to worry about. When you've got 625 banks, now there's a lot more to keep an eye on, right? There's a lot more things that can go wrong there. So you got to ask yourself, is that really what they want? Do they really want a ton of banks and to have to try to keep an eye and then get embarrassed when something like a Silicon Valley Bank, right, that was the 16th largest, right? So basically, if that's the 16th largest bank, that's the 16th most important bank for them. But you could say maybe that wasn't even the 16th most important because also a lot of the people that had money there were higher net worth individuals, and usually they have to worry about folks that maybe aren't in that category, right? So maybe that was actually the 25th most important. And it's no different than when I talk to you guys about building out a portfolio of stocks, right? You could own 100 stocks, let's say, for instance, but if you own 100 stocks, how much are you really going to be able to pay attention to the 100th stock, right? If you own, let's say, 10 to 20 stocks, now you can keep tabs on those 10 to 20 companies very easy. I feel like the sweet spot for the average investor out there is 10 to 15 stocks, right? It's much easier to keep track of 10 to 15 stocks, what's going on with those companies, the conference calls, all that stuff, than if you own 75 stocks. There's no way you're listening to 75 conference calls unless you are a professional investor and that's all you have to dedicate your time toward, right? I mean, I own roughly 25 stocks or so, right? But I have all day, every day, to listen to conference calls, to look into companies. That's all I do. All I do is record YouTube videos, run the private stock group, the private wealth group, right? And literally just look into my companies, what's going on with them. Okay, this happened, oh, they reported this, oh, they got a new SEC filing. I have that time, right? But for the average person that, let's say you work in a job that, it takes 40 or 50 hours a week from you, you don't have that sort of time, right? So you have to kind of be positioned in 10 to 15 companies that you like the best for the long term. And so when it comes to these regulators, who's to say they don't want it to be the bigs and only the bigs? It's less for them to worry about, a lot less for them to worry about, to be quite frank.
6% here, really to 5%. And now at the end of the year, I'm looking on CME and Fed Fund futures are at 4% at year end. So what we did was we got the relief rally associated with the Fed stopping. But the truth is, the aftermath of this, I think actually the economy, if you believe it's going to slow down, it just accelerates.
The relief rally, oh, sir, you in for a rude awakening.
That slowdown because banks have to really pull back in their activities.
Danny, so, the saying is the Fed keeps going until something breaks.
The fact that he thinks a one-day rally is all we got in this whole situation, that's interesting.
I think this was... this was a small vase sitting on the window. So again, what I really think is in terms of breaking, obviously this wasn't on a lot of people's bingo cards, right? It was on certain people that have been actively shorting some of these names that saw this balance sheet that had massive issues. So I just really feel like we still have underestimated in this market in general what is happening when you raise rates 4.5% and what may end up being 5%. We'll see what the Fed does next week. Maybe it's another quarter point. And the other thing, Melissa, is
we're seeing it play out in real time. We're seeing it. We're seeing it, sir. In all due respect, this is what happens when you raise rates like that. Backlogs decrease for home builders 20, 30, 40, 50%, right? You're going to get some of these smaller, not thought about banks that can go under. I mean, that's what happens.
QT, quantitative tightening that's been going on. Great job. We got it down from $9 trillion to $8.4 trillion. I think we can safely say that QE or the QT is probably done here, and we're back in somewhat of a QE, at least a neutral mode. So we got some stuff done, but the problem here is we still have inflation.
And if things get rougher at all, QE. Once again, this is why it makes it so tough to be a short somebody super pessimistic, because the government's going to look at this. 16th largest bank, mostly high net worth individuals, bails.
And I believe that you are now brought forward the potential for stagflation as a result, because the Fed still has to do their job, because what you don't want to see is them to stop while inflation is still running hot.
Yeah, it's a tough choice, financial stability versus price stability. It's a tough one. Danny, it's always great to speak with you. Thank you so much. Danny Moses. And as we sit here talking to Danny, Wells Fargo just filed.
I covered on the main channel CPI today, and one of the things I covered in that video I released on the main channel today was the fact that 70% of the problem we have for CPI right now is housing related, and that's going to become less and less of a problem as this year goes along, because the amount of rentals hitting the market is ridiculous right now. And so landlords are going to have to lower prices, or they're going to sit on homes in apartments or whatever for 3 months, 6 months, 9 months, and just have to keep eating the cost, or they can actually get somebody in there. And so it's going to be quite combative, I would call it that, the rental market over this next year, in terms of landlords fighting for customers, which they haven't had to do in quite some time.
For $9.5 billion mixed shelf securities, debt, warrants, units, purchase contracts, guarantees.
Yes.
Your first reaction to this, Karen?
Good for them. Everyone should file a shelf, right? Everyone should. If you can do it now where there's sort of no cost to it in terms of your reputation or anything like that, you should. It does also make me wonder, if you go to this window and bring whatever assets you have, is that like a walk of shame? Is it like going to like a methadone clinic?
So?
I think so.
Yeah, totally.
I think so. But do we need to have that disclosure? I don't know.
The disclosure that it's a walk of shame, or the disclosure
who went to the window? What did they? How much did they bring? Right. In 2008, the government said, we're giving all of you a huge swath of common, and so we're not going to tell you who really needs it.
This is Wells Fargo, by the way, who has the lowest loan to deposit ratio, right? I mean, they're the ones we were lauding yesterday. They're at 37%, and of the federally insured ones. And so they seemingly were the most defensive money center bank here, based upon at least those ratios.
So I guess the question here is, Courtney, you've been in some of these larger banks. Mm-hmm. Does your view of them change now?
And what's been happening with this, even before last week, is people have been looking at alternatives. Even the big banks, right? They're putting their money in treasuries. They're better options because they're not paying anything on the bank accounts right now. So yes, you're getting the shift right now from your mid-region banks into your large cap banks. But even then, they're either going to have to pay more interest to keep people there, or they're going to see more deposits go out, because now people are realizing, if I have above the FDIC limits, or just in general they're not paying, they are going to start to park money elsewhere, which does affect their bottom line if they're going to have less margins because they're having to offer more interest. So it does affect the banks in general.
Mm-hmm. Guy?
It's interesting. I'm getting on the Twitter. You get a lot of Twitter comments
during the show.
And people are saying, well, there was a study apparently that Silicon Valley, if they were under the auspices of this stress test, they would have passed it. Okay, I'll play that game. So what does that say about the stress test then?
They're lousy.
I mean, they're lousy.
There's something wrong.
There's something wrong, right? There's something fundamentally wrong. So I don't think we're nearly out of the woods to this thing. To Danny's point, small vase, I mean, I don't know what broke. Something clearly broke. We've been saying it for a while. But the pickle that they find themselves in now is, if they stop and inflation is a problem, which today's numbers indicate, what happens from there?
So when you're in a bear market, right, or let's just call it whatever kind of market. And you can make a strong argument that we've already started the new bull market because a lot of stocks have already bottomed and are up 50%, 100%, especially a lot of growth stocks, the Teslas, the Shopify's, NVIDIA's, the AMD's, Metas. I mean, there's a quite substantial long list of stocks that are up substantially here, right? But when you're in one of these sorts of markets, the market has to keep trying to look for the most extreme situations. And basically, we're at the end of the road now at this point in time, right? We've had the fears about valuations. We had the fears about the Fed. We had the fears about the inflation, right? The Fed, valuations. We had fear about the economy, wages, all those sorts of things, right? And so you start running out of things to even fear. The last one, and it's the most extreme, is banks and a systemic problem in the financial system. Once you've hit that, you have no cards left to play anymore at that point in time because you've already played every single other card. And in terms of kind of what happened in 07 through 09, right, the last card to play obviously was the banking system. But there was a different situation going into that one than this one because obviously this one, the government, the Fed, they're ready to step up as soon as something happens, right? As soon as it's SVB, next thing you know, all deposits are whole, everything's fine. Doesn't matter if you were uninsured, we don't care. We got you, right? And so it's just a very, very different dynamic. And so I think the important thing to understand is, from the bearish side, starting to run out of more and more cards in regards to this whole situation, right? And it's just going to make it a very, I would say, tough dynamic to get the market down in any substantial way. I hope it happens as somebody that is always ready to buy stocks, right? And I'm buying every single week. But it's just going to get harder and harder and harder because you're running out of fear to sell now at this point in time. You're running out of fear to sell. When you've already gone to the stage of bank runs and, the whole system's going down, you got nothing left to play. You played your ace. And that's a tough thing from that side. And so from the bullish side, it's just like now, as Tim even pointed out there, who many times can be bearish, especially around Tesla stock, right? He's like, you already got, likely peak rates, peak inflation, peak fear. I mean, what do you got left after that point in time, right? And that makes it a very tough dynamic. And then just wait till a lot of these big dogs, their earnings start getting substantially better as the year ticks on. And the second quarter is better than the first quarter. And the third quarter is better than the second quarter. And the fourth quarter is better than the third quarter. That's when you really start talking about, oh, man, we're flipping back to bullish mode at that particular time. So very interesting bunch of dynamics. I appreciate everybody joining me as always. You got to take advantage of these sorts of markets, folks. Make sure you apply to join my private stock group and private wealth group if you feel like it's time for you to start taking this stuff serious. I can tell you this ain't going to be like this forever. Bank runs, fears about the financial system, all this talk. I can tell you, you've got this time in front of you, and if you don't take advantage, you don't know what you're doing in this time, you're just going to miss out on a lot of tremendous opportunities, as people missed out on crazy opportunities last year. I mean, Meta stock was what, under $90 a share? It's $190 here a day, and we haven't even started to roll this market yet. Just wait till we start to really roll the market. Oh my gosh, do you know what Meta's going to be at, right? People miss Tesla at $100, $101, right? Today it's 183. Do the math on that on a percentage basis on just what you've missed in the past few months. Shopify was $25. It's like 43 today, right? NVIDIA was 110, 115 bucks. Today it's 240, and we haven't even started to roll this market yet. We haven't even got the NASDAQ rolling yet. The NASDAQ's 4,000 or 5,000 points, still down from its highs. You know what I mean? So there's people miss out on these opportunities. They talk themselves into this and that. And all I'm telling you is you better get rolling, man. You better take this stuff serious. You better understand financial statements. You better understand how to value these companies, how to take advantage of deals in the market, understand the markets, understand building out a great portfolio. Because if you're going to miss out right now, I don't know what to tell you, man. All you're going to be is just another person that's going to be jaded at the market because you missed your opportunity, and then you're going to be hoping it goes down, and you're going to be like, the market shouldn't be going up, and it is what it is, man. And for bulls like myself, we never fear. Like, send the market down, we're going to buy stocks for cheaper. Send the market up, we make a ton of money. We're good either way. Appreciate y'all. Much love as always, and have a great day.